Hi everyone, and welcome back to the channel. We receive a lot of questions about RSP accounts, especially when it comes time to cashing them out. So in today's video, not only are we going to be covering how RSP withdrawals work, like the tax implications when you take money out, we're also going to be showing you two of the most expensive unknowns about withdrawing from your RSP that can cost you hundreds, if not thousands of dollars if you're not careful. So let's get right into it. When it comes time to taking money out of your RRSP, think of withdrawals as being the same as getting paid at work. If you were to cash out $20,000, then it's the same as earning $20,000 at your job in the eyes of CRA. Meaning, just like you would normally pay tax on that $20,000 if you earned it at work, you will be taxed just the same on a $20,000 withdrawal from your RSP. So when it's possible, you want to be cashing out your RSP when your income is lower. Why? Because in Canada, we work on a progressive tax system, which basically just means the more money that you make, the more tax you have to pay on every additional dollar that you earn. So let's assume that you're currently not working and you withdraw $20,000 from your RRSP. Your taxes owing, assuming you lived in either Alberta, Ontario, or Nova Scotia, would look a little bit like this. If, however, you were working at the same time, already earning $45,000 a year at your job, and then you also decided to withdraw $20,000 from your RSP, your taxes owing on that same withdrawal would now instead look a little bit like this, as you're now in a higher income tax bracket. You earned more money, so you now have to pay more tax on each dollar that you earned. Now let's take a look at the two most common unknown facts about RSP withdrawals that you need to be cautious of. First up is income splitting. If you're nearing retirement or in retirement, you may have plans to start withdrawing money from your RSP. As you've probably heard, once you're retired, you can start splitting your income with your spouse every year to help lower your taxes. What you may not know though is that certain types of income are only allowed to be split once you reach a certain age. With RSPs, that age is 65 even if you've converted the account into a RIF. The second most common unknown, and probably the most upsetting to people who have experienced this, is that aside from being charged income tax, you also need to be mindful that RSP withdrawals, since they are considered the same thing as income, will also impact your income-tested benefits. Those are the benefits that you receive which can change over time depending on how much money you make. Example of these would include things like the Canada Child Benefit, GST credit, Old Age Security, and the Guaranteed Income Supplement, just to name a few. The more you make, the less you will receive for all of these benefits, and in some cases, depending on how much you cash out, it could eliminate your eligibility for them altogether. So whenever possible, speak to your advisor or your accountant to run the numbers ahead of time before you make a withdrawal, just to ensure you won't be disqualified from receiving future benefits that you were counting on in the upcoming year.